All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hi, Katie. Beautiful spring day here in the Northeast United States.
Yeah, for sure. I'm loving this weather, so hopefully it stays longer. But lots to talk about today, so why don't we jump right into it? First up, earnings season started today with the big banks. So how did it look?
Well, actually, it looked pretty good. They all did well. They're all the big banks, JP Morgan, Citigroup, Wells Fargo, are all trading up. There are a couple of things that everybody was looking out for. One is banks are a good leading indicator of the state of the economy because they have loans out. And if they think the economy is going to go south, loans normally people who default on their loans, loan default rate goes up. So they have what's called provisioning for loan loss reserves. And JP Morgan, for example, added more provisions for potential loan loss reserves down the road, but not that much. And so I would say, they're poised for a mild slowdown, but not a big one. That's for sure. I think there's two kind of issues for the banks right now. One is just stabilizing the deposits. Janet Yellen has been pulling her hair out trying to convince everybody that they're not going to let anybody's deposits go under no matter what. So this is very tricky for them. It looks like it's going to be very difficult to raise the deposit insurance limits, which is currently $250,000. So your bank deposits are insured up to $250,000. But Yellen has basically said that there is an implicit backstop to all of this. And that is they may or may not be able to raise the insurance deposit limit because that's a congressional act they have to do. Congress may not get its act together to do that. But they have certain powers, the Federal Reserve and Treasury, to help essentially stabilize and bail out a bank that's going under. And so the game here is Yellen has said, we may or may not be able to raise the insurance deposit limits, but if any bank goes under, the depositors are going to be made whole because we're going to step in and provide liquidity to that bank so that the depositors don't lose money. So is that an explicit guarantee? No, it's not. But it's an implicit guarantee. And I think people need to understand that. And hopefully all of this, we're going to pull money out if I have 300,000 in a bank instead of 250, and I'm going to pull 50,000 out and put it in another bank. That's kind of silly. There's no reason to do that. There may be additional issues for commercial depositors. And the solution to this may be ultimately just hire more insurance. The FDIC runs an insurance business, essentially. The banks pay insurance for these deposits. And there may have to be some deal where you get higher insurance limits, but individuals and banks pay more for that insurance. But there is no reason for anyone to be worried if you've got $350,000 in a bank that their $100,000 is under risk because it's $100,000 over the $250,000 limit. That's silly. There's no reason for anyone to be concerned about that anymore. The second issue is a little more serious, and that's real estate. If you look at these big commercial banks, and I don't mean JP Morgan, I mean the regional banks like PNC or Fifth Third or Comerica, big super regional banks, their primary business is lending, and their primary business, if you look at it, is real estate, commercial, what we call CRE, commercial real estate. That's their largest holdings. Some of them also hold significant residential mortgages, but commercial real estate's the heart of this thing, and that's a problem. I mean, the simple fact is office buildings, for example, are less valuable than they were 3, 4, 5 years ago. Obviously, not as many people are going in. They're going to have to find some way to sort of write that down. And that's a little bit of an issue. And I think that can be an overhang for a number of years. But it's potentially quite manageable. So let's find some way. The banks are going to have a problem because they're going to have to pay depositors more money. Everybody knows I made fun about my mother putting all of her money into CDs and asking about buying 1-year and 2-year Treasury bonds because why should she keep money in a savings account, in an on-demand savings account? My mother's been pulling money out. They're going to have to pay more for those deposits, my mother included. So I think that's an issue down the road, and it's going to weigh on bank profitability, and so is the commercial real estate portfolio. But other than that, by and large, and the one bank everybody looks for is JP Morgan, their results were very good.
Well, it'll definitely be interesting to keep watching as earnings season goes forward. So thanks, Bob, for that. Next up, a question that we get a lot here, is a recession coming soon? What do you think?
Well, the problem is, what is a recession? What the hell does that word mean? Some people say a recession is when you have 2 consecutive quarters of declining GDP. That's a pretty bad definition. There's an organization called the National Bureau of Economic Research, NBER, and they're sort of the arbiter of recessions. They actually declare a recession. This always happens afterwards because you never know when you're in it. And they define a recession as a significant decline in economic activity spread across the economy that lasts more than a few months. Well, that sounds nice, but that's hard to define too. It literally is that nebulous. And they only do this after it happens. So we could be in a recession right now, but we won't know it for 6-8 months from now. That's a problem, right? So there's a lot of guessing that goes on. For my purposes, I cover mostly the stock market. So my interest is what happens in a recession to stocks. And this is a very well-studied phenomenon. There's all sorts of papers on this. If you go towards a recession, as the NBER defined it, there's been, I think, 10 of them since 1955. And generally what happens is prices go down, generally peak to trough. The S&P declines 25 to 30%. Earnings tend to drop 10 to 20%, sometimes even more. In 2008, 2009, earnings dropped 50%. And the multiple, the PE ratio, which is what you're willing to pay for a future stream of earnings, generally 25 to 30%. So the PE ratio on the S&P, the forward earnings estimate, is 18.5 right now, somewhere around there. That's very high. The norm is about 17. In a recession, it could drop to 12 or 13. So if you do these numbers on the S&P and assume you get a normal recession, you could be down in the 3,000 range, on the S&P, which is where some people were 6-8 months ago. So it's very tricky right now. The market seems to be priced for perfection. What's perfection? Perfection is a soft landing where you have almost no real economic downturn. Forget about the word recession. Market is basically betting right now that things are going to be okay, that if there's a downturn, it's going to be really, really mild. Right now, for the first quarter in earnings, they're expected to be down about 5% from the same period last year. The second quarter is expected to be down about 4%. But the third and fourth quarter are expected to be up. So if you put all that together, you smush all this together, earnings are expected to be up about 1% this year. Now, the chances are that that's probably a little optimistic, but that's not down 10 to 20%. So you see what I mean? The market's kind of got this perfect thing. Now, the bulls point out something that's very important. They said, last year, in 2022, the S&P 500 dropped 25%. From the peak in January to the bottom in October, it dropped 25%. That's about the historic norm for a recession. And the PE multiple dropped 25 or 30%. That's about the historic norm. Now, you can say, where's the recession? But historically, and the bulls have a point about this, the market bottoms before the recession because it smells it out. The market's a discounting mechanism, often 6, 7, 8, 9 months. So if you had a market bottom in October, you add 6 months to that, we're right here. Under historic norms, a recession, at least some modest recession, would start right now. So they have a point about this. The problem is earnings never really drop that much and happen. So this is maybe a weird recession, one of those recessions, if you get one, that's very modest, where the earnings don't drop that much, and you pull out of it very quickly, or it may not. See? So that's why this is so hard. That's why the stock market goes crazy in these numbers. It goes all over the place because nobody can agree on this. There's people. What side of the soft landing are you on? Are you in that soft landing camp or are you in the harder landing camp? If you're in the harder landing camp, the stock market should be a lot lower. So, like I said, the bulls are in control of the narrative right now.
So, Bob, earlier this week, we got the March CPI report. How did the market react to the report?
Well, the bottom line, if you want to look at inflation, it's coming down slowly, but it's definitely coming down. So year over year, the CPI, this is the Consumer Price Index, was up 5%. Historically, that's high compared to the last 10 years, but it was 9%, over 9% in June of 2020. So it's been going down steadily, 9.1, down for 7-8 months now. That's good. That's progress. And the Producer Price Index, which is a level below that, which is the wholesale manufacturing level for inflation, what the producers are actually doing, also has been dropping. So all this is good news. The question is it coming down fast enough for the Federal Reserve to stop raising interest rates? And the evidence is they're starting to pay attention. There's a debate going on. It's not clear. There's still a bet they're going to raise rates one more time, 25 basis points in the beginning of May when they meet again. But most of the market is betting that that's going to be it. And there are substantial bets being made that they may reduce interest rates. Now, the Federal Reserve has made it clear they don't want to do that right now because inflation is still too high. In a sense, the market is playing against the Federal Reserve and what they think is going to happen. So, again, there's not, if this was that easy, everyone would be millionaires. It's not. So it really is not entirely clear what's going on. The only thing I can say is I am optimistic inflation's going in the right direction. By the way, there's two big components here. There's services and there's goods. Goods are like stuff you buy, like clothes and air conditioners. The goods part, inflation is going down a lot faster because that bottleneck we had during COVID where everything got screwed up and the supply chains got screwed up is getting fixed. And commodity prices are lower. That's good news. What's still high is the services. That's mostly jobs, how much money people are getting paid. They're still demanding more money. That's not necessarily a bad thing. I was in favor of that, particularly for low-income people. But you have to stop it from becoming endemic, where every year you're expecting 6, 7, 8, 9, 10% raises. Otherwise, inflation will never go away. So that's the component of inflation that's still pretty high, and we'll see how that goes. But that's an interesting bet. That's going to depend a lot on the economy.
So, Bob, it's mid-April. We're a few months into the year now. How have the markets been doing so far this year?
Good. Well, surprisingly well. So we ended the first quarter up 7%. And historically, when the first quarter ends up strong like this, like 7% strong, the full year is almost invariably up, which makes sense. You're up 7%. But not only that, it's almost invariably up more than 7%. So historically, that's a very good sign. And we're seeing good signs. One of the things you really want to watch in the market is what's called breadth. Breadth is how many stocks are going up versus going down. Remember, the stock market is mostly market cap weighted. So the biggest stocks by price and shares outstanding have the biggest sway in the S&P 500. And those are tech stocks, Amazon, Apple, Google, Microsoft. You want a market where not just, 20 tech stocks out of 500 are going up. You want a market where the broad market is going up. Steel stocks are going up. Healthcare stocks, utilities are going up. And recently, the breadth has been very impressive. We have seen very nice continual rallies in things like healthcare stocks and industrial stocks and material stocks, the copper, for example. That's a real sign. If I had one indicator that I pay attention to more than anything else, it's breadth. When more stocks are going up every day than are going down, that's a good sign. That means people are in buying stocks on a regular basis. So overall, I think the market's holding up very well. And this is another aspect that I'm telling you, if you accept the idea that the stock market is a discounting mechanism, it's a mechanism to figure out a future stream of profits 6, 8, 10 months from now. That's about as far out as anybody can think and get right. Then the stock market is basically positioning for a soft landing in the economy. And it may be wrong, by the way. It's just a discount. It doesn't see into the future. It tries, but right now, that's what it's saying.
Yeah, I think that's really helpful for our viewers to think about, not just strength in one part of the market, but kind of broader across the board. So Bob, shifting gears a little bit now, where do you expect crude prices to be this summer?
Oh gosh. Well, I don't make predictions on where crude's going or stock market's going or anything like that. I would just point out how what moves crude, what moves oil. So crude oil is a commodity. Commodities are subject to the laws of supply and demand. So what do we have in supply? Well, we got this cartel out there called OPEC, Organization of Petroleum Exporting Companies, and they have been trying to control the supply of crude oil for decades. Sometimes they're successful and sometimes they're not. They have some members on the periphery, what's called OPEC Plus, that are having a lot of problems. I mean, Russia, for example, is a major supplier of oil, but it's unstable. The country is unstable. And there's restrictions on how much Russian oil you can buy. There's restrictions on prices, price caps on that. So you have a weird supply dynamic that's going on here. On the demand side, that's determined by economic conditions, things like, wage growth, job growth. Generally, lower prices in oil and gasoline stimulate demand. More people drive. The price of gas is $2 versus $4. Right now, I would say the demand side is pretty good. The other thing you have to remember that nobody thinks about here in the United States is demand for oil is very strong in emerging markets. There's a lot of people out there in emerging markets around the world where their family's getting a car for the first time, like Africa, even parts of Asia, even parts of Latin America. And that's a big driver. Even parts of China. This is a big driver of global oil growth is what we call emerging market consumers coming in for the first time. So this gets stupidly complicated. And I'm going to tell you, I would put very little stock and store in anybody's estimate on where oil is going to be 1 year from now. There's no way on earth you're going to get the number right. There's too many supply demand shocks that can happen between now and then to make any sense. Right now, I would simply make the observation that the demand side remains strong. China is reemerging from COVID, and that is probably the single most important thing that's out there. You're dealing with 1.3 billion people. The United States is, over 300 million, but China is 3 times larger population-wise. So that's a major factor right there. So I'd say demand is strong. I would say supply is adequate to a little bit on the tight side. And beyond that, I'd be careful about listening to anybody's oil prognostications.
So, Bob, our next question, how can beginners enter the market? And then what is the market? Can you kind of elaborate on that for us?
Yeah, beginners can enter the market by owning a broad swath of it at once. You don't have to think that hard. People get confused looking at the stock market, but the S&P 500, which is 500 of the largest companies in the stock market, is 80% of the value of the United States stock market. You can own the other 20% if you want. I can show you how, but if you simply bought the S&P 500 as an ETF, and there are many different ways to buy it. The biggest one is SPY, that's the Spider S&P 500, but VOO, IVV, VOO is Vanguard's S&P, IVV is iShares. You can easily own 80% of the market in a single stock. When you do this, what you are doing is you are going with the stock market. You are not trying to beat the stock market. Generally, the academic evidence is you cannot beat the stock market. Most people lose doing this. Most people spend too much time trying to figure out how to beat the stock market. It's better to stay with it. Why? Because the market tends to rise over time, and you do very well over time. So if anybody asks me what, I don't give out financial advice. I'll just tell you what anybody else will tell you. Own the broad market. What people come in who are long-term financial advisors on CNBC is own the broad market, and you can own them through index funds. If you want to own smaller parts of the market, like small cap stocks that are not in the S&P 500, you can buy that in an ETF as well. Just go type in. You need to have a brokerage account, but there's dozens of great online brokerage accounts out there. There's Vanguard, Fidelity, Schwab, E-Trade. They're all they're all good. You can all own them. You own these ETFs and own these index funds through those various brokerage accounts. I would not, if you were a young person, I honestly would do that and not worry about it too much for a number of years. You can have discussions with a financial professional if you want about owning bonds. There are some good arguments to be made now that bonds are getting in the 3 and 4% yield range about owning them. And you might want to consider that. And there's ways to do that as well, but it's not that complicated. Generally, I am in the Jack Bogle camp, who founded Vanguard. Bogle urged people not to try to pick individual stocks, but to own the broad market. And that includes the S&P 500. So I have not changed my feelings on this for 20 years. I wrote a book, Shut Up and Keep Talking, Lessons on Life and Investing from the Floor of the New York Stock Exchange. It's out on Amazon. You can buy it. But this whole chapter is in there about my own journey, literally a journey in investing going back 30 years. And I describe what I owned, why, how I lost money on things, and why I became an indexing and Jack Bogle disciple. So I describe my own journey here. It's not that I'm sitting here, pontificating like I'm some college professor. I've been doing this for 33 years and have my own experiences, some of them wonderful, some of them painful, that I describe in the book.
Yeah, I think there's definitely a lot we can learn from our past mistakes and, ways to get better moving forward. But I think you're right, Bob. For anyone looking to enter the market, there's some key things to keep in mind in staying long term. So our last question is a fun one. What is your favorite Grateful Dead show that you either attended or listened to, Bob? The people want to know.
Yeah, the Dead is on tour again this summer. Maybe the last time, who knows? My favorite Dead show of all time was a very famous show, or series of shows. It was called the Wall of Sound Tour. And it occurred in Winterland, which was a venue in San Francisco, gone now, in October '74. So that was almost 50 years ago. That's kind of scary, but I went. And it was rumored to be the last of the Grateful Dead. They were going to break up because they were so exhausted from touring. They'd been touring for years. They had a series of wonderful albums out, beginning with American Beauty and Working Man's Dead in 1970, and Mars Hotel had come out in Europe '72. And this was, we didn't know this, but the Dead were were in the middle of their great golden age. So they put on a show in Winterland, October '74, and it was called the Wall of Sound because they had a sound man. His name was Augustus Owsley Stanley. This man was legendary because in the '60s, he made the LSD for all of the acid trip parties that were on, which the Dead went to. He was a chemist. He was sort of the first person to ever manufacture LSD on a large basis and sort of made a lot of the Summer of Love psychedelia possible. And he got arrested and for that. And, I think he went to jail for a year or two. But he was always close to the Dead. And he emerged in the early '70s as their sound man. And he built this enormous sound system called the Wall of Sound. And when I say enormous, I'm talking 600 speakers. They wanted to make the most perfect sound system. The problem with sound systems at rock concerts, most of you know, have been to one, is it's very muddy because you run a lot of guitars and drums and amp through small amounts of amps. Well, they said, what if we do the opposite? What if we take just a single guitar and throw a whole bunch of amps at just one guitar? And the result was this thing called the Wall of Sound. So I got there, and the speakers, the 600, it literally went to the top of Winterland. I mean, you just look up, it's like several stories, and you're just staring at it. It's the biggest thing you ever saw. And when they started playing, you'd never heard sound so clear. Like Jerry Garcia's guitar was just so, you'd never heard something so clear. We've been used to hearing this muddy sound system. And Phil Lesh had a bass. He was a bass player. When they were playing, I remember my cheeks were vibrating. It was so intense just to be, I was probably 100 feet from the stage. And that show, actually, you can see it, parts of it. There were 3 or 4 of them, as I recall, in October '74. But it's called the Grateful Dead movie. Garcia wanted to make a movie out of it, even though they didn't know how to make movies. But the movie does exist. You can see me. In case I'll say I waved to myself in the crowd somewhere, trying to find myself. But it was amazing. Ultimately, they had to stop doing the tour because it was so big they couldn't carry it around. There were literally, as I recall, 2 crews, one to break things down and one to set them up at the next venue, and they couldn't literally afford the crews going for the shows. So it broke up, and they stopped touring. I think that was it. In October 74, they stopped, and then they didn't do anything for the next 2 years. I think they started touring in 1976. It was Wake of the Floods, probably. And then they embarked on another mini golden era. The 77 through 80 tours are very well taped and are among the best shows that they ever did. So if you ever had a chance to look at the Grateful Dead movie, there's a very famous moment in the back of it where I don't know how, but they got a camera in the back of the room when the Dead came off, and they went into the green room to just relax for an encore. And Garcia's exhausted. You can just see, he said, what do they want? You can hear us screaming, all of us in the back. I'm tired. What else do they want? It was sort of like the fans are never happy, which is true. You find the sound in entertainment, no matter what you do. You could die on stage and they want you to resurrect and do more. And it's exhausting. And he was obviously tired. And we didn't know it, but that was going to be it for them for a couple of years. So there you go. That's sort of a favorite moment. By the way, I had dinner with Bob Weir the other day, the lead rhythm guitar player for the Grateful Dead. He was kind enough to show up at an exhibit in San Francisco of old photographs from 1966 from Haight-Ashbury. A photographer named Herb Green had taken them, and these were the very earliest pictures of the Grateful Dead and the Jefferson Airplane in the dawn of psychedelia. And there was an exhibit, and he came, and he was very nostalgic. And there was, a dozen of us had dinner for a fundraiser, and he told a very amusing story about how he met Jerry Garcia. December 31st, 1963, he was walking down the road in Palo Alto looking for a folk club, and he heard Jerry Garcia playing the banjo and knocked on the door and said, "Hi, I'm a guitar player. Who are you?" And he said, Jerry, I'm Jerry. I'm waiting for a student to come to teach banjo. And he said, "Well, Bob said, it's New Year's Eve. I don't know. I don't think your student's going to show up." And he said, "Oh, maybe. Want to come in and talk?" And that was it. That's how they met. And he told a number of very funny stories about the day he turned 21 and Pig Pen took him out for a drink for the first time. But he was very relaxed and nostalgic. And it was wonderful to see him so relaxed and talking about the Dead, because all of this is now passing into mythology and history. Even in 1974, when I was 18, there was mythological, stories about the Grateful Dead, and it's just wonderful that Bob's still around.
Yeah, what a great story, and so cool that you had a chance to speak with him. And I'll definitely have to check out that movie for sure, Bob. It'll be interesting.
Wave to me.
Yeah, I'll take
I'm there.
I love that the concert was, 50 years ago too, and you can still so vividly remember all of that.
Oh boy, yeah, I remember it very well. Mm-hmm. It was really intense.
Yeah, it sounds like it.
I went to that show. Those speakers, I'm not kidding. Your pants moved. Your cheeks wobbled. It was just intense.
Yeah, for sure. Well, thank you for sharing that, Bob. I know everyone's always interested about all of your music history. And then thanks for answering all of our questions. We'll talk to you again in a few weeks. Have a nice weekend.
Thank you, everybody. Have a good weekend. Get outside. It's a beautiful spring weekend.
Yeah, for sure. So have a good one, Bob. Talk soon.
All right, take care.